Picture this: February 1985, Grundy County, Iowa. It's 9:17 a.m. and you're standing at a farm auction in the dead center of the American balance sheet recession. The banker is there. The attorney is there. The neighbors are there, arms folded, faces tight, watching a family liquidate a lifetime because interest rates went vertical. Just 4 years earlier, the Federal Reserve had pushed the federal funds rate to nearly 20% to crush inflation. Farm loans repriced. Land prices cracked. And when farmland values fell hard, collateral evaporated. Then you notice something strange. A small cluster of bidders who don't look like the locals in seed company caps. Straw hats. Plain coats. Quiet talk. They aren't emotional. They aren't even impressed. They're patient. When the bidding starts, they don't reach for credit. They reach for cash and community. And while Wall Street sells hedges made of paper promises, these people are buying productive land with a system designed to survive exactly this kind of shock. The most effective hedge against financial collapse isn't an asset. It's a social technology, one refined over centuries and mostly ignored. The mainstream story says resilience comes from sophisticated portfolios, a little stocks, a little bonds, maybe some gold, maybe some crypto. Rebalance quarterly and call it risk management. History tells a different story. Across multiple states and generations, a parallel economic model has quietly reduced exposure to the three things that destroy household wealth: leverage, counterparty failure, and catastrophic expenses. Not through prediction, through structure. That structure shows up repeatedly across history. During the Great Depression, the inflationary 1970s, the farm bust of the 1980s, and the correlation collapse of 2008. And once you see the pattern, you can copy the mechanisms without copying the lifestyle. Start with leverage. Leverage is a silent wealth killer because it turns time into an enemy. If you own an asset outright, you can wait out bad prices. If you own it with debt, the calendar owns you. From 1929 to 1933, the U.S. economy collapsed into deflation. Prices fell, incomes fell, and the real burden of debt rose. Good assets still destroyed people if they were financed wrong. Farms, shops, rental properties, anything bought on optimistic terms became a liquidation event. What mattered wasn't the asset. It was the balance sheet. The same pattern repeated in the early 1980s. Farmland surged during the inflationary 1970s. Credit was easy. Then rates spiked. Land prices collapsed. In parts of the Midwest, farmland values fell by roughly 60% from peak to trough. When collateral falls that much, a leverage balance sheet doesn't recover. It implodes. This is why certain buyers appear at auctions during busts. Not as predators, but as survivors of a culture that treats debt like fire. Useful, dangerous, and never allowed to spread. The lesson repeated again in 2008. Equities collapsed. Housing collapsed. Credit froze. Even assets marketed as safe havens wobbled when forced selling hit. Debt was the accelerant. Debt turned volatility into permanent loss. The first hedge is simple. Don't build a life that requires constant refinancing. Survive a bad year without selling. Then comes the second layer. Imagine a household facing a $300,000 medical event. In a mainstream model, that risk is routed through employers, insurers, deductibles, networks, billing codes, and months or years of negotiation. In a mutual aid model, catastrophe risk is absorbed directly. Cash payments, negotiated pricing, obligations enforced socially rather than contractually. This isn't folklore. It's a functioning financial system, just not one with a ticker symbol. For decades, U.S. law has recognized that some communities operate alternative risk pools and therefore opt out of centralized insurance systems. Whether you agree with it or not, the implication is revealing. These groups aren't uninsured. They're self-insured. When catastrophe strikes, the system pays quickly because it doesn't need to litigate intent, satisfy shareholders, or route claims through 5 intermediaries. This isn't unique. Before the modern welfare and insurance state, millions of Americans relied on fraternal societies and mutual aid organizations for sickness and death benefits. These were real risk pools. The model worked at scale. One reason it worked was cost. Modern healthcare burns extraordinary amounts of money on administration, billing, coding, compliance, and claims warfare. Mutual aid strips that overhead away. Fewer intermediaries. Simpler payments. More transparency. Stronger incentives to avoid abuse. This doesn't make it perfect. It makes it efficient. Mutual aid handles individual catastrophes extremely well. It struggles with systemic shocks unless paired with reserves and productive capacity. Which brings us to the next layer. Financial assets are claims. Real assets are capabilities. When systems destabilize, claims get contested. Capabilities keep working. Land, tools, workshops, repair skills, small enterprises. These don't rely on counterparties behaving well. They produce value directly. During the inflationary 1970s, long-duration bonds were destroyed in real terms. Cash lost purchasing power, but productive assets repriced upward. Farmland rose dramatically in nominal value. Then rates spiked and leveraged owners were wiped out. The lesson isn't that real assets are magic. It's that real assets plus low leverage survive both inflation and the policy response to inflation. Even in extreme cases like Weimar Germany, the people who remained functional weren't those with the best paper hedges. They were the ones with access to food, goods, skills, and networks. When a unit of account fails, the unit of survival replaces it. The hedge isn't a metal. It's a production system. The same truth resurfaced in 2020. Global supply chains snapped. Shortages appeared. Lead times exploded. Communities with local production and repair capacity experienced disruption differently. Less upside in boom times. More continuity when things broke. The point isn't self-sufficiency, cosplay. It's redundancy. Then there's information. Modern finance loves centralized models, credit scores, automated underwriting, securitization. It looks scientific until assumptions break. In 2008, lending scaled precisely because lenders didn't know borrowers. Risk was pushed downstream. Incentives fractured. Local underwriting works in the opposite direction. Your habits are visible. Your reputation follows you. Access to future support depends on current behavior. Reputation becomes collateral. This kind of enforcement doesn't scale globally. That's why modern economies built courts and credit bureaus. But when centralized systems misprice risk, local systems stabilize it. A hedge is something that performs when the main system fails. Underwriting quality does exactly that. Centralized models fail when assumptions break. Local models fail when communities fracture. The strength lies in cohesion. Finally, there's the layer that doesn't look like finance at all. Most people don't go broke because markets drop. They go broke because fixed costs trap them. Car payments, lifestyle inflation, subscription creep, bigger houses, more debt, less margin. Then a downer arrives and the math turns brutal. Suppressing status consumption isn't about loving austerity. It's about rejecting a game that destabilizes households and communities. Lower baseline consumption creates flexibility. Fewer fixed obligations mean fewer forced decisions under stress. In the U.S., savings rates routinely collapse during booms and spike only after crises. That means many households run close to the edge by design. Consumer credit fills the gap. This is pro-cyclical fragility. A counter-cyclical household looks boring in good times and resilient in bad ones. Lower recurring costs, higher shock absorption, less need to sell core assets at the worst moment. Put all of this together and the pattern becomes clear. Deflation makes debt heavier, low leverage wins. Inflation weakens currency, productive assets win. Credit freezes kill refinancing, low leverage wins again. Catastrophic expenses bankrupt households. Mutual aid absorbs them. Institutional failure breaks promises. Reduced dependence survives. This structure covers more failure modes than any elegant portfolio theory because it doesn't require the system to behave. And the demographic signal is unmistakable. Communities built this way don't just survive. They grow. Expansion requires economic viability, not ideology. The uncomfortable truth is that most hedges sold to you are just correlated bets with better branding. Diversification looks brilliant in calm markets. In stress, correlations converge and forced selling dominates. The resilient structure isn't trying to outsmart the market. It's trying to outlast the market's failures. It lowers leverage so volatility doesn't become liquidation. It limits counterparty exposure so institutions can fail without taking you with them. It socializes catastrophe risk so one bad event doesn't equal bankruptcy. It suppresses status consumption so households carry real margin. These ideas are ignored because they don't generate fees. There's no commission on lower fixed costs. No ETF for mutual aid. No management fee on knowing your neighbors. But history rewards boring structures that don't blow up. Look at the current environment. Households, corporations, and governments depend on rolling debt. Balance sheets assume stable rates. After years of near-zero interest, duration risk piled up everywhere. When rates rise fast, something breaks. Trust is also decaying. As cohesion falls, transaction costs rise. Litigation rises. Fraud rises. Resilience falls. Around the world, the same math shows up under different flags. Persistent inflation, capital controls, trapped deposits, slow erosion rather than sudden collapse. In developed markets, the risk arrives quietly. Higher insurance, higher taxes, higher interest expense, and less margin every year. This is exactly the environment where low leverage, real assets, mutual support, and low fixed costs outperform. Not because it's romantic, because it's arithmetic. So boil it down. Survive recessions without forced selling. Absorb catastrophe without bankruptcy. Maintain function when claims fail. Price risk with real information. Keep fixed costs low so life stays flexible. Cut a major fixed cost. Build real mutual support. Add productive resilience. Reduce dependence on any single institution. And remember that auction in Iowa. One group needed rates to fall and credit to return. The other needed patience, community, and a balance sheet that could wait. The pattern is mathematical, predictable, merciless. The only question is which structure you choose.